Welcome back, everyone, to the Behind the Well Show. I'm your host, Roger Abel, here with Elias. How you doing today, buddy?
Oh, man, I am awesome. I actually got to watch Jeff Bezos and his brother, a guy named Wally Funk, and a kid named Oliver go to space this morning. So that was really cool.
So I didn't see it. I knew they were going. Was it like they just went for a brief time and came back, or what's the background?
So the whole trip took 10.5 minutes, 10 minutes and 30 seconds. So really, they launch in this rocket. There's a pod on the top. They get to a certain elevation. The pod separates from the launching part of the rocket. And then they made it up past I can't remember what the line's called, but it's like the internationally recognized elevation to be in outer space.
Okay.
And then came back. And the two different parts of the aircraft or the spacecraft landed in their two different landing areas, and the people commenting, and then what it appeared to me, everything went according to plan. And so I'm sure that was a really good, I thought it was really cool. I was juiced and I didn't go. I just watched. So it was pretty cool.
It is cool because there's like this little battle between a few companies trying to get there, but they're all playing nice in the sandbox.
Yeah.
It's really Virgin Galactic, Blue Origin, which is Jeff Bezos, and SpaceX, Elon Musk. And what's interesting is you can actually buy a ticket to go. And I know I asked you earlier what the cost of a ticket was, and you're like, well, I don't really know. So I pulled it up here. Virgin Galactic's, you can get a ticket, and that's Richard Branson's company, by the way. You can get a ticket for $250,000. That includes a spacesuit. That seems like a relative bargain.
Did you find what Bezos is going to charge to
I've
do that?
I've got all of them.
Okay.
So passengers going to go on SpaceX, $55 million. They get a sleeping bag and hygiene products. And Blue Origin, $28 million. Comes with the seat next to Jeff Bezos. So it's pretty expensive to go.
Yeah.
But I think it's interesting, and it's one of those things we talked about in our last show. If you remember back to that TikTok video, the Amazon video, where they thought at one time Amazon was just selling books.
Right.
And the company was way overvalued.
Yeah, and then there were analysts saying, well, they'd have to sell every book in the world to even be profitable.
This is kind of the same thing, because this is kind of a pioneering frontier as to what this unknown world of space travel could be. And there are investments which you can have access or exposure to space-type missions, or not, something to that effect, space and robotics.
Right. Exposure to like this new space exploration industry that's starting to form.
Exactly. So, yeah, I think that's really cool. And it made me do a little research to see what was going on, but it kind of shows also the separation in kind of income inequality potentially between the 1% who can afford to drop, $250,000 or $28 million on a flight, and average everyday investor. Which I was reading an article on MSN, and the article was titled "The Ultra Rich Are Saving Their Money Instead of Spending It," and now the middle class is buried in debt. And I wasn't really sure how this was going to play out. But this was put out by the Chicago Booth Review, which I'm guessing was with the Booth School of Business over in Chicago, basically saying the 1% has buried the middle class in debt. And the idea is because the 1% has so much money they're saving, it's more access to banks to go ahead and lend out. And this, we have a low interest rate environment for middle class people. It fuels borrowing. Right? Because all of a sudden, that house that was a 4.5% mortgage rate, I'm getting at 2.75 today. Better get that rate. Or, man, instead of saving up to pay cash for that car, I'm getting 1 or 2%. Why? I mean, we've heard that. Why would I pay cash if I could do this? And the 1% is keeping their money in savings because they don't have to borrow, right? Which is allowing more lending.
Financing, yeah.
Yeah, so I thought that was a really interesting article that was out there. And is some debt productive? Yeah, I mean, there's productive debt. If you're going to buy an asset that potentially could appreciate in value, especially right now, if you think about what's going on, we have all this talk of inflation, and inflation's real. It's here now. Mm-hmm. But if you went and locked a mortgage rate in at 2.25% or 2.75%, and you've watched the value of your home price go up dramatically, for some people that might be the best purchase they've made. I'm not going to call your home an investment because I don't believe it's an investment unless you're going to sell it and take the gain. Most people don't. But from a pure wealth building standpoint, for a lot of people, that is one of their largest assets.
Yeah, it is. And this question here in this article is debt productive. So what I was thinking about was, okay, so when is debt like really bad for you? Well, it's really bad for you when you're going paycheck to paycheck just to make your payments. Now, if you are saving at a good contribution rate, I'm talking about your long-term savings for whatever age you are for your goals at the end of that, and you want to borrow some money to buy a car or even finance a house, because if you can, I would say like a vehicle, if you can pay for it, just pay cash for it and be done with it. But if it's a matter of I need a more reliable vehicle so I can get to work, and you have some money for a down payment and you can finance it for a while and help your cash flow, like to me, that's a productive use of debt. But I think what people need to watch out, and especially in the middle class, is if you can afford the $30,000 car, but now you want to get into the $70,000 diesel pickup or whatever it may be, because that's just what you want, but you really can't afford. That's when debt really becomes unproductive, and that's when you're going to run into problems.
Well, I think there's another side of this coin too. There may be people analyzing what we call the opportunity cost of their dollars. And what I mean by that is, let's say we have a individual has a stock portfolio or investment portfolio, whatever it is, and it's generating X return. They may look at that and say, well, if I sold $50,000 of these funds to buy this car, I gave up the return. Let's say it's 5%. Well, if I earn 5 there, but I could have borrowed at 1 for the car, they may be looking at an opportunity cost analysis there as to whether I should do it. So it's not just if you're borrowing to make a payment, it could be borrowing to utilize the opportunity cost of the money you've accumulated.
Yeah. So you're borrowing so you can keep saving, or at least not
keep earning your interest.
Yeah, keep earning interest on that money.
It's easy math.
Right.
If you borrow at 1 and you're earning 5, you're net 4 ahead. That's easy math. That said, if all your money's in your savings account, you're earning 0.5%, and the loan you're taking is 2%, you might as well just pay cash for it because you're still paying more interest than you're earning. So I just kind of thought that was a really good lead in to that article and how we're seeing some of the wealthiest people in America save money and use it in different ways. And the other article I ran across, and you remember Daniel Crosby, he wrote the book, Laws of Wealth, and there's another one he wrote, but I follow him on LinkedIn. Do you follow him on LinkedIn?
No, I don't follow him on LinkedIn. I've read his book, The Laws of Wealth.
Okay. So I follow him. He usually posts some pretty eye-opening stuff, and most of all of his information revolves around, personal finance and behavioral finance, right? How people behave with money, and the whole idea that a person's behavior probably has significantly more to do with their outcome financially than the actual investments that they have.
Yeah,
and he
or ability to analyze investments and all that kind of stuff. Yeah,
so he posted an article, not an article, just a chart, and it caught my eye, and that's why it caught my eye. And it said the value of advice increases over time. And I kind of changed the verbiage there. It compounds over time. We've talked about the compounding effect where you have a young person who starts saving money at 20. They have a lot of years to compound. Just the compounding of wealth. Well, this was the difference in household financial assets attributable to financial advice. Okay? And how it compounds over time that they're receiving financial advice.
Okay. So it's like we're looking at a comparison of do-it-yourselfers versus working with a professional.
100%.
And then the amount of wealth accumulated?
Over time.
Okay.
The difference in wealth over time.
The difference. Got it.
So most do-it-yourselfers think they can figure this out, and they very well could. Most can. And this highlights why they're really not doing that great of a job. No advice, obviously, is the bar. in 4 to 6 years, someone who's been receiving advice, and this study is done by the Investment Funds Institute of Canada. So it's a Canadian study, but it doesn't matter.
Yeah, and psychological behavior is very similar.
It doesn't
no matter
change.
Where you are. It's
They're
like
highly regulated.
Yeah.
They're a very highly regulated market, more regulated than in America. So over 4 to 6 years of receiving financial advice, on average, the person getting advice has 1.58 times the financial assets of somebody not getting advice.
So just over 1.5
1.5
in the ballpark of 5 years. 4 to 6 years, 1.5 times.
Yep. 7 to 14 years, it's 1.99 times. So almost 2 times.
So you're almost double.
And if you've had 15 years of financial advice, 2.73 times.
And that's being with an advisor for 15
plus years.
And these are averages.
Right. So what it goes down to is how many people, think about this, how many people go and get an advisor? What's the big event in most people's lives? I'm retiring. I better see about doing this financial plan today.
Yeah.
Wait until I'm 57.
A lot of people, yep.
Think if they would have started when they were 32
Yeah.
or 42, where they would be today. What this shows me, though, is even though you might feel like you're doing a great job, there's benefit to financial advice.
Absolutely.
So if you haven't met with an advisor or you haven't got any advice, I'd ask everybody to go to the btwellshow.com and click the button, look for a planner, get a plan. We help people do that. But this highlights why what we're doing is important. It's easy for me to get on the show and say, hey, you should do a financial plan and move yourself from the bias to the unbiased probabilistic world. That's easy to say. This supports why we believe in that. No part of this study talked about the best investment. The best investment someone can do is get a financial plan and get financial advice. That's the best investment. It's not whether the next hot meme stock is going to take off or Bitcoin's going to the moon or I have tendies flying everywhere. I don't know. The best investment's planning for your future so you have this really nice glide path and you execute a plan. One time you equated it to a football game. You don't go to the Super Bowl and not have a plan.
No.
Right?
No one's winging it. And no one's winging it in general, certainly not the Super Bowl.
And think about what an individual investor Super Bowl is. It's retirement.
Yeah,
right,
that's
man?
the big event.
That's the Super Bowl. How do we make sure we win the Super Bowl? Or like you talked about your basketball coach, how do we put ourselves in the position to win the Super Bowl?
Yeah, right. And I've said this before on the show, and I've actually said this in conversation with people, because one thing that gets brought up, and, we have meetings with prospective clients and other people, and sometimes people ask, or just in general, they'll make a comment in conversation, well, why would I pay for something that I can do for myself? Well, studies like this show that the average person is not that effective at doing it for themselves. And the other thing I'll pose to people is say, show me someone who started with an advisor when they were in their 20s or or even around 30, who started with an advisor, got good advice for 30 plus years, and turned out unsuccessful at building wealth. And was there a cost associated with that? Yes. But if you hit all of your goals, the fee that you paid to get there, is it even relevant at that point?
It's not relevant. It's the net result.
And then just like this study, after 15 years, if you're 2.7?
2.73 times.
Yeah, so 2.73 times the wealth. I mean, we could raise the fee. We could charge 3 times what we're charging. Not that we're going to. I'm just saying, like, it's to me, that's insignificant. That's not a good reason. Saying, well, I just don't want to pay someone. To me, that's not a good reason to not get advice from a professional.
You know what? If they're hung up on the fee, they'll be less successful because they believe that's the thing that's going to make them successful is the lowest cost. And that's not true. Vanguard has a study that quantifies the value of an advisor. It's close to 3% a year. And this is by the company who believes in low-cost investments. Are low-cost investments important? Yeah. But if you're working with a fiduciary, they're going to get you into the investments that make the most sense for you as an individual in your unique circumstance.
Yeah,
so,
and they're cost conscious of the portfolio anyway, and the investments that are in it.
Someone says they don't want to pay the fee, they're just not that serious. They really
Yeah.
don't want to go through this. Maybe they're nervous about what they're going to find. You know, it just doesn't make that much of a difference because most people's fees are fair. I just saw, I was watching The Compound, of course. They were talking about the greatest hedge fund of all time. And I didn't catch the name of it. It's Medallion or Magellan. I'm going to go back and watch it. It's just like really brief. Since 1980, this fund had averaged gross of fees like 68% a year.
Is it it's probably the Renaissance Fund, I think.
Nah, I don't know. I'll have to go back and watch. But here's what I found amazing. Do you know what their fee was that they charge people?
Most hedge funds are like 2 and 20, but I think this one's like even higher, like
5 and 44.
Yeah, because they can charge whatever they want.
5% of asset management fees. So 5% at the top, 44% of profits. Net of fees, it returned to their clients 39% a year.
Annually.
So how relevant was the fee? It wasn't. Yeah, if you look at the 66% and say I paid 30 in fees, I think every single person out there would love to get 39% return on their investments, net of fees.
I mean, if you don't think that's fair, you're crazy.
But think about how people think. If I said, "Yep, the fee's 5 and 44, 5% a year and 44% of the profits."
Oh, no.
What's the first thing? No way, I'd never do that. Really? Okay, move on. The interesting thing about this is they realized that they couldn't grow the fund larger than $10 billion and still be able to make the maneuvers and trades they needed to make. It's a 100% quant fund, so it's all mathematically driven. It was started by a mathematician. So it takes out the human emotion of everything. Yeah. And all the money today is primarily employee money. They've returned all outside money. So even family, friends, and family of the owners, they've returned money to. It's literally just owners and employees at this point that they're managing funds for. But I thought that's a great highlight to why fees aren't that relevant. What's relevant is the net result, right? Here's another example of why fees aren't relevant. If you sold your house today, you're going to pay a realtor. If you sell the house for net more than you do on your own, did it matter that you paid the realtor 7%?
No.
And typically they're going to get more money for you because they know how to market it. We all think it's easy to sell a house. It's not that easy.
No.
So I just think it's important for people to realize that financial success and wealth shouldn't be valued in fees. It should be valued in the advice that you're getting, because that will lead to longer term returns. And we've seen study after study after study that shows that.
Yeah, I mean, you're exactly right. So the value of the advice that you're getting from your advisor, and then we talk a lot about the value of time, desire, knowledge, and how, that's what we become when people decide to delegate those things to us. And then, so we're talking about the value of advice. And so this article came across, COVID-19 cases may cause an S&P 500 correction. So we've seen there's like a little bit of resurgence in COVID-19 cases. Yesterday, the market was down. I haven't looked this morning, so I don't know what the activity is. I think the futures were suggesting it was going to open up. But I actually have a couple thoughts on this. And the article talked about what we're seeing there's this thing called the July chop. So when you have a strong first half of the year, a lot of times there is a decline in the month of July. And I guess people use the term the July chop. So a couple things I thought about. We've already had a strong beginning of the year. And then I was wondering, so let's say the market just traded relatively flat for the rest of the year with the gains that we've already seen. And if there were no more gains to be had this year, don't you think most people would still be happy with the result?
I mean, I don't know where it's at, but most people with some type of a balanced portfolio, or they even have some bonds, they're probably between 8 and 10% return on the year if you're all equity, 14, 15, 16, depending upon where your assets are positioned, obviously.
Right.
If you were all in growth, you might have underperformed because we've had value companies be a little bit of a catalyst. But we're seeing stuff like small cap who had a great run. They've already pulled off their highs. But it highlights why having a plan and a very well diversified portfolio makes sense. I pulled up a chart, and we use this for years, but this is actually from Schwab. And it says stock market corrections are not uncommon, right? And I think that we are stuck in, if you look over the last 11 years, we've really had two corrections. The fall of 2008, the market went down 18 to 20% in a quarter, and it came right back. And then COVID, which was
2018, you mean?
Yeah, 2018.
Yeah.
Market went down 18 to 20% in the fourth quarter. It came right back. And then COVID last year is the first, market corrections we've really seen. And to be honest, there hasn't been that much downward pressure anywhere over the last 11 years. But here's what's interesting. Schwab has a chart. We'll put this on the website. If you want to see it, it's btwellshow.com. And it talks about how market corrections are not uncommon. Okay.
It's common. It should
So
happen. It's going to happen.
Here's the drawdowns over the last 20 years. I'm going to read these, and then I'm going to read where the market's finished. Okay. So 2003, the market at one time, top to bottom, went down 13%. Market finished positive 28.7. 2004, there was a 7% drop. Finished positive 10. There was a minus 7 in 2005, top to bottom. Finished it up 4.5. In 2006, the market went down 7.8 one time, finished positive 15. You can see the trend. The market has corrections. It's not a straight line up, so we should expect volatility. If the market went down 7, 8, 9, 10%, that wouldn't be the end of the world. People right now have this bias that it is the end of the world because of what just happened with COVID. We had the big drop. Mm-hmm. So I'm like, oh man, it's going to happen again. It doesn't mean it's going to happen again. Volatility is normal.
Yeah, and that's what I actually read. I think it was a book called The Excellent Investment Advisor, and he was commenting on how when he talks about volatility, he doesn't even use that language. He always says, well, short-term price fluctuations. So I almost think that's a good way for people to think about it. Is it's such a short-term fluctuation in the price. And the other thing that all the events you were just talking about where there was a drawdown, the market came back. So hopefully what investors have learned is that by sticking it out and not selling, just like our example of the worst investor of all time, you can buy in at market highs and just never sell and still be successful. Well, hopefully people were rewarded enough times by sticking to their planning that now that's just like going to be the way they operate, where, yeah, maybe they do expect a sell-off or some point or a drawdown at some point, and they're already planning, well, I'm going to stick with it because this has been working.
Okay, let me tell you what's ironic. The next line under this chart, this is put up by Schwab, having a longer-term plan and sticking to it is key to investment success.
Well, yeah, we know that. It
sums up everything. It's just ironic. I didn't know that was there because I just pulled this chart up when we were talking. But it's just ironic that if you just think of the common theme here, it's having a plan, a long-term plan, and sticking to it and executing it.
Yeah. Drowning and ignoring the noise. Like, I understand that, if the new variation of COVID, that could cause a lot of bad things, but some of it market related, you do have to have an ability to just block that out and don't let it bother you.
And clearly it's unknown what's going to happen with this new Delta variant because, there's talk of, disallowing some travel, and we've heard the word shutdown. I don't know if they're going to if they'll actually do that or not. But at some point it won't be like it was, last spring, I wouldn't guess, because we have a certain percentage of the population is vaccinated. Mm-hmm. So it's not like we have to shut this whole country down because we don't have a solution to the problem. But that leads into another thing. We're talking about the market going down. Another thing going down, and it's COVID related, Elias, is on July 17th, Yahoo Finance brought out an article. It says U.S. mortgage rates fall for a third week as COVID-19 delivers uncertainty. And mortgage rates have been historically low, for a long time. But you're seeing mortgage rates now back to, on a 30-year, about 2.88 is what's quoted here. But what's ironic, November 2018, mortgage rates hit 4.94%, and we're at 2.88. Yeah. And I had a talk. I went to an event, great event, called Aiming for a Cure down in Iowa City this past weekend with one of my bankers. We were talking about this and talking about, probably get your house refinanced now because we'll probably never see a lower interest rate. You know what I said to him? I said, I've been playing that game since 2002.
Yeah, it's a 20-year
like 11
game.
Time.
That's a 20-year game now.
And while we believe they probably won't go lower, we don't know that.
Yeah, right. It's still a prediction at that point, right?
begs
We don't know that it's going to go.
It begs the question: are we more likely to go to 3% on the 10-year or negative? I don't know.
Yeah, I don't know. That's a good question. I guess I've heard some compelling arguments that we could go to negative interest rates, but isn't the Federal Reserve they're saying they're not going to do that?
Well, there's other ways to stimulate the economy. I don't know as if the economy actually needs lots of stimulus right now. With inflation rises with different things. Right. But I thought that's interesting as, interest rates are starting to fall, signaling that they're a little concerned about what's happening with the new Delta variant of COVID.
Yeah, and I had a client call me the other day and ask about a refinance, and I just asked her a rate. I think she said she's paying like 4.25%. And then with rates as low as they are, I said it would probably make sense to just go ahead and refinance, lock it in for 30 years, lower your payment. Or I think what the bank was talking to her about is she could refinance to a 15-year and her payment would basically be the same that it is now, but she could accelerate the date that it's paid off. So I thought both of those scenarios will work out good for her.
Yeah, I mean, if you have a good banker, most good bankers will tell you, hey, here's the numbers. I mean, you could go out and find an amortization calculator. Just look at this is how much I'm going to save over 15 years by doing the different loan. If it makes sense to do it by the time you pay closing costs, and you might have to pay an origination fee, just find out what all the fees are. Mm-hmm. But usually, depending upon your loan, if you save 1 to 1.5%, maybe it makes sense to refinance.
So should we talk about meme stocks going into their longest losing run since the frenzy began? We're talking about things going down.
Yeah.
So apparently there's 37 meme stocks that are tracked by Bloomberg. And right now, collectively, the 37 are in their longest losing streak. So longest streak of going down in value since, when was it? Was that in the fall? Was it in the fall when that started, the short squeeze on GameStop?
I think it was more summer. It was kind of right
close to the end of summer.
Yeah, I believe. I'd have to go back and look at exactly when it started, but some of the biggest names in there is GameStop, AMC. AMC's actually down 25% since that time. But at some point, the question begs with the meme stocks: can the momentum stay forever? At some point, do they just run out of energy to do this? Does the sizzle of the Reddit board and the get rich quick idea start to sizzle? And maybe we're seeing that. Another company in the meme stock that saw huge gains was Newegg Commerce. It's lost 60% of its value in 2 weeks after going up 287% in 3 days. So it just goes to show that for most people, this shouldn't be part of your long-term financial plan, buying and trying to pick an individual stock, because the losses come as fast as the gains come. And more than likely, you're going to get caught on the wrong side of that. And what I mean is if you bought it when it went up 287%, you just lost 60.
Yeah. Well, and it goes back to the story in our office, I think you said Jeff tells, where you can win 8 out of 10 times. But this is a scenario where if 1 or 2 of those situations goes just catastrophic against you, you could lose everything that you had in it from the beginning. So yeah, I mean, could it work? I'm sure there's people that have made money doing it, but that could. I'm sure there's a lot of people lost money too, I guess is what I'm getting at.
You don't hear about that. That's like a gambler. You only hear when the gambler wins.
Well,
you don't hear about the losses.
Yeah, or sometimes I hear from people tell a story of a stock that they bought and it went up, and then a lot of time that story transitions to, well, then I got stupid.
Yeah.
So it's like, okay, so when did the shoe drop?
Let
me hear the rest of the story.
No one ever tells you about their losers. They don't tell you about how they crashed and burned.
Yeah.
That doesn't sound fun and exciting. So,
every gambler, they're even at the casino for their life, right? That's the story.
The classic is, I won 600. I won 600 on the machine last night. They didn't tell you that they put in 7. Right? You think about it when you see someone holding up their ticket $600.
Yeah.
Well, that just means you pulled 600 out of the machine. It doesn't actually tell you how much you put in.
Right. Well, yeah.
I can put 1,000 in and draw it down to 600 and hit a ticket and be like, I won 600. I didn't win anything.
That's how it's all narrative at that point.
So
it makes you feel good.
If anybody out there is looking to move themselves from the biased world into the non-biased probabilistic world and get out of the gambling mentality, go to our website, btwellshow.com. We'd be happy to get you a plan and move you out of that kind of gambling mentality if you're there. So any other closing remarks for the show, Elias?
Just everybody, thanks for listening. And if you want help, just reach out to us. We'd be happy to help you.